WeWork lost its $47 billion dream in just a few years. Why did that once-hyped startup collapse so abruptly? In 2019, it was hailed as the world's most valuable startup. Yet, its valuation vanished by over 99% in just 4 years. But what happened? In fact, WeWork's failure harbored systemic causes that continue to repeat in the modern business world. What was the true nature of this collapse? This video will unravel why success sowed the seeds of failure, who overlooked critical warnings, and what lessons modern companies can learn. Let us now delve into the full scope of WeWork's $47 billion collapse. In this main feature, we will also explore the character of founder Adam Neumann and the profound impact he had. In 2010, WeWork was born in a corner of New York, proclaiming a grand vision, the Facebook of physical space. It was touted as more than just a rental office. It was a community, a place that would transform the very way people work. Founder Adam Neumann exuded charisma, captivating investors. His words seemed like magic, promising a boundless future. A place where young entrepreneurs gathered, offering free beer and coffee, quickly became synonymous with the cool office environment. Against the backdrop of Silicon Valley's fervor, WeWork expanded at an astonishing pace, reaching major cities worldwide. In early 2019, fueled by massive investments from SoftBank, WeWork's valuation astonishingly reached $47 billion. Its corporate value effortlessly surpassed that of established corporations and traditional real estate companies. It shone as the darling of its era. Neumann boasted that his company was the world's first physical social network to benefit from capitalism. WeWork's initial success perfectly aligned with the rising demand for flexible work styles. For startups and freelancers looking to curb fixed costs, easily accessible office spaces were highly appealing. Modern design, comprehensive amenities, and above all, community building garnered significant support. Leasing properties long-term and renting them out on short-term contracts. This seemingly simple business model appeared rational. Its branding as a technology company also proved successful, positioning itself as a tech company rather than a real estate firm. Neumann's vision to elevate the world's consciousness attracted many young people and assembled top talent. SoftBank's Masayoshi Son also resonated with this vision. His belief as a kingmaker who had nurtured numerous companies sent expectations skyrocketing. Up to this point, everything seemed to be going smoothly. As a unicorn company poised to change the world, its growth knew no bounds. However, in the shadow of its success, numerous question marks began to emerge regarding Neumann's management practices. He had inflated his personal assets and enriched himself with company funds. His extravagant lifestyle had become uncontrollable. Expansion proceeded regardless of profitability. Even as vacancy rates rose, WeWork continued to lease new buildings. Despite being a real estate company, it defined itself as a tech company. Investors, expecting high growth, tolerated the losses. In the relentless pursuit of growth over profit, the business model's vulnerabilities were overlooked. High marketing costs became the norm. Neumann's blatant self-dealing was evident, such as owning the rights to the company's We logo and selling it back to the company for $5.9 million. Without an independent board of directors, the excessive concentration of power in the founder's hands led to a fatal lack of governance. But here, a trap no one noticed had opened. Behind the fervor, the countdown to collapse had already begun. Why could no one stop this madness? The biggest factors were the investors' herd mentality and FOMO, fear of missing out. Driven by the expectation of becoming the next GAFA, investors vied to pour in capital, and the sums became limitless. SoftBank, in particular, injected colossal funds, becoming a key player in inflating WeWork's valuation. By repeatedly making massive investments, the investors themselves fell victim to the Concorde effect, making it impossible to pull back. Voices of doubt were drowned out. Critical opinions were dismissed as simply not understanding the vision. Within the organization, a groupthink mentality, where it was difficult to dissent due to Neumann's charisma, became widespread. Both investors and management turned a blind eye to reality. It was an abnormal state where fantastical narratives took precedence over financial backing. Everyone believed profits were inevitable, and an optimistic illusion enveloped the entire organization. Rational judgment was paralyzed. In August 2019, WeWork filed for its IPO initial public offering. However, the submitted documents shattered all illusions. The publicly disclosed financial statements revealed colossal losses, a complex management structure, and Neumann's blatant self-enrichment. Investors and analysts unleashed a torrent of criticism, condemning it as just a real estate rental business, not a technology company. WeWork's lost credibility sent its valuation plummeting. From $47 billion, it crashed to below $10 billion in just a few weeks. Founder Adam Neumann was forced to resign as CEO. His ousting symbolized the very end of an era. In November 2023, WeWork finally filed for Chapter 11 bankruptcy. Its former brilliance had completely faded away. WeWork's collapse is not merely the failure of a single company. It is a classic tragedy born from the divergence of vision and reality. It highlighted the dangers of modern startup fervor, excessive investor expectations, and overly dominant leadership. Why did success sow the seeds of failure? Because vision-first expansion and a lack of governance led its growth to self-destruction. Who overlooked what? Investors prioritized the illusion of being the next GAFA over financial health, while management favored hubris and self-interest. The lesson for today, drawn from this tragedy, is the importance of discerning fundamental business principles, rather than being swept away by hype. Sound management and transparent governance are what sustain lasting growth. Dreams alone cannot keep a company alive. The quality of future decision-making will vastly differ between those who understand WeWork's failure and those who do not. We hope this history prevents future mistakes.